Good evening. This is Ken Long from Tortoise Capital with a trading lesson on applying sideways quiet channel analysis to daily trading time frame and to demonstrate the power of the Tortoise Mastermind chat room. I'll add some thoughts about building proficiency on the way to mastery. So RG in the chat room was talking about a strategy where he looks for elephant bars, which look like large range breakouts that are very directional from congestion zones. And so he identified for a swing trade symbol ZNGA. And he was looking at B1. He noticed a wide range bar, or what he called WRB, that had moved off the 20-period moving average. And it's a clearing bar, meaning that it had closed higher than this previous congestion. Then he noticed this large move up, a sell-off that culminated in a bottoming tail, a wide range day that had more than 50% of the bar as a tail, and then a close in the top half of the bar. Almost looks like a washout, then an intraday recovery, followed by 1 day of increased performance, and now we think we might be able to frame a trade either inside this candle or upon the second day of momentum, aiming for a retest of the swing high with the stop below the bottoming tail. So we've been doing some work on this in various time frames, and there's some research and back testing that suggests that bottoming tails are an attractive way to play for intermediate term turning points in conjunction with the 20-period moving average over these longer term time frames. And so this was Bob's analysis, where he's actually combining the idea of bottoming tail with this elephant bar notation. He posted this idea in the chat room. We had some discussions about it. I then added some of these markups. I added the yellow shaded areas to show what I saw as a sideways quiet channel. The slope of the moving average was flat, narrow channel, defined tops and bottoms, and what I liked was a series of higher lows, and then a breakout in this first, in the second blue circle. I saw this as a breakout from the previous trading range, and I saw that as the first hint, and then a triple top, really, or quadruple top, and then a breakout. So I like this as a breakout from sideways quiet channel with a stop below the moving average, which in this case would have enabled participation in that move. I also like this doji after some congestion that finished higher than the support level, which used to be resistance level, and then a breakout from there gives a directional move. So I like this entry because it clears the first elephant bar breakout, clears the doji, and is off and running. This looks to me on the third day of momentum, looks like an opportunity to either have a frog trade or a second position. This large bar in here, somewhere in here, there's an opportunity to cash a two-trade position, and then it still leads into stalking a re-entry or a continuation or a channeling or a buy on pullback with the bottoming tail combined with the elephant bar. So there's a number of different ideas in here that will meet some different strategies. So as Robert and I were talking this out in the chat room, he was using the acronym WRB. Well, some new members in the chat room didn't know what WRB meant, and so as a way to demonstrate one of the features of the chat room, I showed them this chart, which says, here's how you use the search function inside Campfire, which is the platform that we use for our chat room. Now, the Campfire chat room saves all the archives and the thumbnails and the image files that we can upload. And so if you just go to the Files, Transcripts, and Search tab, you get this. And if you type WRB into search results and hit search, what you get is, in about 5 seconds, a complete listing of all the instances in which the acronym WRB was used. And you can click on those links and go to that. Let me move this out of the way. And so you can see we first started talking about WRB in March of 2008, and over time we've had some various discussions as Robert has been tweaking around with that particular idea of wide range bars, in just wide range bars in particular. He's added elephant bars since then, but the point that was that in the chat room, regardless of whether you were there or not, you can use a search function to really zero in on a lot of contextual reflective learning. Well, when I looked at that, I noticed March 2008, and it's almost March 2013, and it struck me that that's just on that search, we've returned 5 years of archived daily trading practice. And then that reminded me of the concept that originally comes from Anders Ericsson and then was later popularized by Gladwell, about the idea of 10,000 hours of focused practice is the gateway towards achieving proficiency and ultimately mastery. Then doing some quick math, because at work we were taking a look at some manpower studies. I saw that 40 hours a week times 50 weeks a year is 2,000 hours per year, times 5 years is the 10,000 hours. And so what this already is representing is 10,000 hours of focused practice leading towards proficiency in the craft of trading. But it's not just 10,000 hours of working, it's 10,000 hours of focused practice. And by that, Ericsson and Gladwell mean that it's planned, purposeful, measured, accountable, reflective, meaning that you're thinking about the performance, you go back and examine it. You can't do those without having it measured, and accountability is what causes you to do it with discipline. And then we remember Dr. Deming, who says you can't improve a system until it's under control. It's the founding principle of total quality management and statistical process control. And so you have to get the system under control by defining it, scoping it, disciplining it, and then eliminate systematic and systemic variations so that you can focus just on making changes in one variable that allows you to measure the effect. You can't do that until you have a system that's under control, which is reliable, repetitive, defined, controlled. So you have to eliminate the wobble. I mean, it's like following your rules in a mechanical trading system. If you connect that now to the principles of rifle marksmanship, in rifle marksmanship, what you have to do is first get a tight shot group, meaning that you are aiming the same way, and when you shoot at the target, your rounds are landing very close together, and that means that you have a reliable, repetitive system in which you have reduced or eliminated systemic variation. Once you have that tight shot group, then you can adjust your sights to bring the shots to the bullseye. If you don't have a tight shot group, that means that we don't know why you're shooting all over the place. It could be any number of things, and until we fix those, we can't start making adjustments to your rifle sights because it's premature. So the 4 principles of rifle marksmanship, and now watch how these apply to trading, are steady position, meaning that you're comfortable, you're stable, you have a platform, you're not wobbling back and forth. Maybe you have your rifle on a sandbag, or you have it locked into a vise, or you have it otherwise controlled and pulled into your shoulder tightly. So you have a steady position. Then you have a good sight picture, meaning that you put the sights on the target the same way, you look through the sights the same way, you line them up the same way, you put them in the same spot of the target the same way each and every time. Once you do that, then you have breath control. You don't pull the trigger when you're breathing in or breathing out. You wait for the natural respiratory pause, the space in between the in-breath and the out-breath. So you breathe in, you exhale, and then before you breathe in, start breathing in again, you hold it. And in that space between the out-breath and the in-breath, you have the natural respiratory pause. Your body is at complete rest and relaxation. Your breathing is not moving your rifle around. And in that moment, you squeeze the trigger. Trigger squeeze is applied by a rearward steady pressure with constant tension, so that when the trigger has been pulled back far enough that it causes the round to fire, you're surprised by it. You don't jerk the trigger. You don't anticipate it. You give it a slow, steady squeeze, and then when the round goes off, you're surprised, and then if you flinch, it's too late because the bullet's already left the barrel at 3,000 feet per second. So those 4 principles of rifle marksmanship are how you get to be an expert shot. And we've eliminated all of the other things because they don't matter. If you do those 4 things, then you will be an expert marksman. And there's an equivalent exercise for you as a trader inside those 4 principles. And I'll give you the quiz tonight. Use your brainstorming to figure out what those how those principles translate into trading. What is a steady position? What is a good sight picture? What is breath control? Hint, stress management. Trigger squeeze, reliable, consistent entries, and willingness to pull the trigger. So those are some interesting thoughts that came out of the chat room today, and I will tell you that when you have 30 to 40 people in that community actively participating at any particular time, working with each other with accountability on the same style of trading, with using TharpThink and the language of excellence, and basing our improvements on reflective learning and adult learning and accountability to each other with through a professional lens, you have the opportunity to develop a professional practice in a supportive community of practice. And powerful things happen when you make haste slowly and you treat this with respect as a profession, as a member of a craft, working with your guild members, if you will. Don't want to get too crazy on that, but working in a community of practice with trusted others allows you to accelerate some of that 10,000 hours of proficiency. Does the proficiency come after you've committed 10,000 hours? No, it comes along the way, and part of your reflective practice is to notice the things that are working, that are improving, so you can do more of those, and eliminating the things that are not adding value so you can get to the equivalent of those 4 principles of marksmanship. So it's attention to detail every day. It's respecting the tasks of trading. It's acknowledging that the book that you write is the most important book that you can read, and that is your trading journal. So those are some insights from the trading room today and some thoughts on proficiency. And that leads me into a couple trades of the day that we took routinely. The first one was simply just a sideways quiet channel in symbol TNA on February 27th, 2013. This is where the market opened. It had closed flat, gapped slightly down. Morning hook takes off, clears yesterday's close. Make our first entry routinely at 76.37 with a 20-cent stop, which is just below the river. And it takes off immediately when we get a couple R in hand here at 76.80, and it clears this previous sideways part of the ribbon. Add the second position, takes off, gets to 77.70, and that's a pretty good trade already. Simultaneous to that, while TNA, the triple Russell ETF, is going up, we're also making an equivalent trade or simultaneous trade in XIV, which is the inverse VIX ETF. And now that had been, it closed sideways quiet channel yesterday, except for one last little flurry of buying activity at the close. Slight gap down, immediate reversal, starts cruising up. When price ribbon leaves the river, we now have both regression lines and the ribbon leaving the river, and the trend is up. And we've had 2 extraordinary days of selling in the market, which made volatility an extremely lucrative trade. So this is the anti-volatility trade, snapping back essentially. So we get our first entry at 1950 with a 0.2 initial stop down here below the low of the day. It just runs straight north. Take a second position at 20 with 2R in hand and momentum, and cleared the previous swing high, and it's off and running to 2037. Let's see, where do we close those? Here's the closure of those. This is now the S&P 2 days worth, and you can see that it had hit a low intraday yesterday and then took off, had a real strong close, and S&P was going up like crazy, and that made the TNA trade supported. That made the inverse volatility trade supported. So the TNA trade, we end up closing at 77.80 for 12R, and 5.5R on the XIV trade, closing out at 20.30. So there's 17.5R on a routine trade framing, and it's not because we're smart. It's just we were prepared and positioned, and pulled the trigger with persistence, and then got out in a disciplined manner when we get the regression line crossover outside the river, and you can see that exit up in here. That's a routine exit, and then we're stalking to see what happens down in here. Will price get to the Bollinger Band mean? Well, that's another story for another day, but that's the basic trade strategy right there. Now, the final note, what's interesting to note on this also is that at that moment in the market, this was on February 27. At that moment, UVXY, the double inverse VIX, or the double VIX, excuse me, was down 16%. Well, the previous day it had been up 20%. The day before that, up another double-digit figure. And this is just how fast the truth can change with volatility trades. And it really illustrates the difference between swing and intraday trading. So the day before, UVXY was plus 15%. Today, it's minus 17%, and that's a two-day net of 2%. So if you're swing trading, you're trying to do that in the VIX, you're really trying to figure out a rule set that will allow you to position yourself to accommodate swings of 15 and 20% on a daily basis and somehow catch the directional net out of that. Well, you can see after a 15 and a 17% move, the net is only a two-day net of about minus 2%. So what you really have to do with swing trade is get a set of rules that will allow you to fight to capture the net in the midst of volatility that is that wild. So that's why I don't swing trade volatility. I'd rather just try to get some piece of the 15% and some piece of the 17% and try to get tuned into the way the trend is unfolding that particular day. So now if we take a look at a 3-day chart of volatility, this is just UVXY. This is the 27th. Between these two lines is the 26th, and the day before is the 25th. What you really had was a day and a half when it went from $9 to $13.50. That's a 50% move in a day and a half of trading. So you're not fighting for 2%. You're trying to figure out how can you get a low-risk portion of that move. And then it moves from more than 13.5 back down to $10. So that's let's say it's $3. That's probably about 25 to 30% retracement. But the real net over those 3 days was just this yellow period. It went from a low to a high back to a low. The net difference is much less. That's only 2 or 3%. So if you try to swing trade that, what you're suffering is these enormous changes of direction, but with relatively low net. In my view, you're better off to be flat overnight with a volatility trade and then try to get some, again, low-risk portions of these moves. After consolidation points near the Bollinger Band River, the median right in here, notice sideways quiet channels can be very lucrative. And similarly, breakdowns out of sideways quiet channel to the downside reward in a similar fashion. Once you get price action in the regression lines outside of the Bollinger Band River, you get some very interesting results. And then when the regression line crossover happens again and the Bollinger Band mean is crossed, that leg is over, and now you can do something about that trade. Once you appreciate and understand how your target operates and where the trends occur and in what average dimensions over some time period where it seems to be trending, you can then start fine-tuning your strategy to the market as it behaves. And in this case, in my view, the volatility trade is much easier to do on an intraday basis and not try to play continuation patterns from day to day unless you see them happening right in front of your eyes. So that's today's trading lesson about we covered quite a wide range of ideas, but there were some things that came together today that I felt compelled to talk with you about. So thanks for your kind attention and good trading. Keep your risk measured and your powder dry.